Michael Burry, the man, the myth, the legend, saw all this coming. Despite predicting all of this at the start of last year, he's recently stated that we're only halfway there.
Nearly every failed institution and every relevant department of government, there was someone whose insight was every bit as good as mine, and in many cases better. However, none, zero were in the top job. That our CEOs, our governors, our presidents, and our chairmen did not see this coming, did not adequately prepare their constituencies, is an indictment of the manner in which we choose and enable our leaders. But such would not be the conclusions in 2008. Broadly speaking, it's the hedge fund's fault. By the second half of the year, with the government targeting commodity hedge fund managers with punitive subpoenas, the global attack on so-called speculators and evil hedge funds, the nationalizations of Fannie, Freddie, AIG, etc., and their liabilities, very importantly their liabilities, which are now a special purpose vehicle of the government. I worried about the future of a nation that would refuse to acknowledge the true causes of the crisis. In my view, an historic opportunity was lost. America had instead chosen its poison as its cure, and the second greatest generation would never be born. Today, I expect the U.S. government to attempt to continue easy money policies into the next presidential term, past the meat of the foreclosure crisis, and past the corporate and public refinancing humps that are upcoming. With junk bonds incredibly are again at all-time highs. Quantitative easing seems to be working for now, but this is an invalid validation of what America is doing. This is in fact a Pyrrhic gamble. As we continue to debase our currency, Bernanke says he is not printing money. Again, I disagree. As it stands, I get an email every single day from the Fed saying we just bought another 7-8 billion of treasuries, monetizing the debt. In fact, this program, QE2, not Queen Elizabeth, quantitative easing, QE2, its scope and breadth raises a severe question of the Treasury's needs. The government's borrowing of money for the purpose of injecting cash into society, bailing out banks, brokers, and consumers is a short-sighted, easy decision for a population that has not yet learned that short-sighted, easy strategies are the route to long-term ruin. We never quite achieved the catharsis necessary to stoke a deep reevaluation of our wants, needs, and fears.
In that tweet, he mentions two factors that are linked to a stock's price dropping. There is multiple compression and earnings compression. First, multiple compression, which Burry believes we've seen so far. What exactly does this mean? Of course, the most basic and common valuation metric is the price-to-income ratio, which is the stock price divided by earnings per share. If your company owns $1 per share for a year and the stock price is $20, your PE ratio is 20. However, we can rewrite this equation as follows. Stock price equals earnings multiplied by the PE ratio. Or, to put it in another way, the earnings multiple is the multiple of earnings that investors are willing to pay for the stock. The earnings multiple is heavily influenced by what investors believe the company will do in the future. Investors will give it a high earnings multiple because it has a lot of room for growth and will perform well in the future. Whereas issues with the company, such as competitors in the market stealing market share, will result in a much lower multiple.
Importantly, fiat currency and an activist Fed remain firmly entrenched, even more so with the financial reforms last year. In fact, the Federal Reserve, having acquired new powers of regulation, has insisted specifically that nothing in the field of economics or finance was of any help in predicting the crisis. It's a worthless conclusion. It guarantees we will make the same mistake again and again. So I have a problem with leaders.
Michael Burry refers to this as multiple compression. It's really just a fancy way of saying that investor confidence is declining. Last year, investors were prepared to pay up to 35 times the S&P 500's earnings to own it. According to current estimates, that multiple has dropped to around 20. As a result of optimism quickly giving way to pessimism, the market is dropping. That is the main point. Interest rates have an impact on it as well. When interest rates rise, new bonds become more appealing, and the huge money in the market begins to flow out of the stock market and back into the bond market, dragging the stock market down. This is the polar opposite of what we've seen over the last few years. You are aware that interest rates have been extremely low, which causes the stock market to become artificially high because bond returns are practically zero. As a result, the big money is looking to invest elsewhere. But to cut a long story short, investor confidence is dwindling and rates are rising. That's what Burry was saying in the first half of his tweet. Interest rates have an impact on it as well. When interest rates rise, new bonds become more appealing. And the huge money in the market begins to flow out of the stock market and back into the bond market, dragging the stock market down. This is the polar opposite of what we've seen over the last few years. You are aware that interest rates have been extremely low, which causes the stock market to become artificially high because bond returns are practically zero. As a result, the big money is looking to invest elsewhere. But to cut a long story short, investor confidence is dwindling and rates are rising. That's what Burry was saying in the first half of his tweet. But as he mentioned, he believes we're only halfway there, and he believes it's earnings compression that will take over. As a result, instead of unconfident investors driving down prices, corporations in corporate America will exacerbate the situation. America is making less money. This is related to what we were saying earlier. Right now, interest rates are rising due to the crushingly high levels of inflation. In reality, however, this means that consumers have less money to spare. Burry also stated that people's savings are covering a smaller and smaller portion of America's GDP at a time when the GDP is declining. In another tweet, Burry talked about how U.S. personal savings filtered to 2013 levels. He said that the savings rate has returned to 2008 levels, while revolving debt on credit cards increased at an unprecedented rate to pre-COVID levels. So what he's saying is that unfortunately, all this inflation and interest rate increases are leaving consumers with very little in their pockets. Less spending equals less profits for businesses. Combine that with higher costs and rising debt costs, you've got a situation where corporate earnings are in trouble. Amazon was one of the companies that struggled in Q1 and was specifically mentioned by Burry. We can see that Amazon's earnings were doing well, but they crashed and burned in the first quarter. Consumers are unwilling to spend as much, and while we don't put much stock in analyst forecasts, analysts expect the decline to last through 2023 before beginning to recover in 2024. So the numbers reveal the macroeconomics. Operational costs have been increasing at a faster than normal rate since 2021. In addition, the cash flow from operations has decreased. That's the second part of Burry's tweet. Now that we're seeing significant interest rate hikes and the average consumer is having difficulties, Burry believes that corporate profits will begin to fall from here. Remember our equation that price equals earnings multiplied by a multiple or investor sentiment. So far, earnings have remained relatively strong, but sentiment has weakened. As a result, Burry anticipates that the macroeconomic environment will begin to have a significant impact on earnings, bringing down the stock market even further because, remember, rate hikes will continue until inflation returns to normal levels, and we've come a long way so far.